Private equity firms promise a lot, but do they deliver? Bloomberg decided to find out. We gathered data on private equity investments and returns for 3 of the largest U.S. pension funds, and those results will surprise you. Here to discuss them with us now, one of the 2 reporters behind the investigation, Bloomberg's Jonathan Keener. Jonathan, thanks. We should mention that you and Jason Kelly were crunching the numbers and
that's right,
hacking through the tall weeds to get at this. What did you find?
Jason Kelly and I, who's our private equity reporter, built an analysis around the commitments and returns for 3 state pension funds in Oregon, Washington, and CalPERS in California. And we essentially looked at the returns on private equity funds dating all the way back to 2000. The analysis we performed was looking both at returns in terms of IRR, internal rate of return, as well as just a cash-in, cash-out basis. As you know, a lot of these public pension funds right now are really struggling with liquidity, so cash is kind of the name of the game at the moment. And when it comes down to cash, they are way underwater.
How much did they have on hand by last year?
According to our numbers, in aggregate for these 3 funds, they'd handed over about $55 billion in cash and only gotten back less than $25 billion. So there's a $30 billion shortfall there, if you will. Now, that's not money that's lost, of course. That's
right.
Money that's stockpiled right now into LBOs, other investments these funds have done. It's a big question mark whether that money will ever be delivered, how much it's going to be marked down, and what it's going to turn into.
What's key to the profitability here?
The key to it is turning around a lot of these huge LBOs that we've reported on over the last 2 to 3 years. You remember Harrah's, you remember TXU, you remember Clear Channel. These are all enormous deals, in multitudes bigger than in prior funds.
Yeah, but turning those over in this economic environment
is going to be a challenge, yes, for sure. And what's interesting about our data comparing sort of a cash-on-cash analysis to IRRs is when these funds really outperformed back in 2000, 2001, 2002, they were much smaller. So the commitment that went in might have been $50 million. You may have seen a return of 3 or 4 times, but the newer funds, the commitment is in the billions of dollars, and these are the funds that are underperforming. So again, on an absolute basis, this asset class is struggling a little bit, according to our analysis.
Some of these, were they overpaid?
I think you could argue that a few of them were, certainly in the current climate. Now, that's not to say that they won't turn around. And look, these guys certainly have made billions of dollars for their LPs over the years. But it will be challenging for them in this environment.
And given, as you correctly point out, mark-to-market accounting, it's kind of glaring how much they were overpaid.
That's right. Mark-to-market is one aspect of this analysis. The other issue we're finding is there's just no exit for the private equity firms. There's no IPO market. There's no other PE firms to buy them in a secondary LBO. So there's no way to get cash back to the LPs.
So what does that ultimately mean? No exit strategy, I guess. What does that mean?
It means they have to sit on them for now. They have to tool them. They have to bring in restructuring advisors. Sometimes they have to try to keep them afloat, because once they go bankrupt, the equity's wiped out.
Well, when you say sit on them, for how long?
Anywhere from the asset class says it's a 10-year asset class if you ask private equity managers. So in theory, they have years to tweak these things. On the other hand, it's hard to imagine the flush IPO market that we saw, which could really get these funds this large generating big returns.
You and Jason make a good point. You say that the data raises questions about private equity as an asset class. How so?
Well, the point we were getting at there is if you look at how much these funds committed to private equity, they doubled the number in 2005, doubled again in 2006, and I believe doubled yet again in 2007, topping off at about $20 billion a year of commitment. That pace of growth, and behind that was a whole infrastructure in private equity. That's what we meant by the asset class itself may be questioned. I'm not sure you can sustain the infrastructure behind funds that large going forward. In fact, David Rubenstein from Carlyle makes a similar point in the story, that going forward, PE funds might start getting smaller again. They might start raising smaller funds.
And you should mention, too, that this affects private equity managers on both ends of the spectrum, right?
That's right. Yes. Certainly, there's the Blackstones and KKRs that have sort of become almost the old Wall Street investment banks, and then there's much smaller LBO shops that have really stuck to their knitting. I think they're both facing challenging times.
Bloomberg's Jonathan Keener and his colleague Jason Kelly. And if you're watching on your Bloomberg terminal, the story is pension plans, private equity cash depleted as profits shrink. That story appearing today. Jonathan, thanks so much. I appreciate it.
Thank you.